Welcome to Iron Financial. This is the place where we forge stronger portfolios by cutting right through all the market weakness. Today, we are tearing down Uber's Q4 earnings report. Now, the company itself, they called it a record-breaking quarter. But the market? The market responded with an absolutely brutal sell-off. So the question we're going to answer today is pretty simple. Did Wall Street just find a fatal crack in Uber's armor? Or is it completely ignoring the solid steel frame that's been built underneath? I'm your lead analyst.
And I'm your market skeptic. You know what? Let's just cut the intro and get right to the only number that really matters today. This right here. This is why we're having this conversation. Negative 8.8%. The day they announced these so-called record numbers, the stock just got hammered. I mean, the market didn't just dislike the report, it actively punished it. So my first question is a simple one. What on earth did they see that made them slam the sell button that hard?
And that, right there, is the heart of the whole contradiction. While the stock was basically in a free fall, this is the victory lap statement coming from the CEO, Dara Khosrowshahi. He's using words like record-breaking, largest and most engaged consumer base ever. I mean, these two realities, a brutal stock drop on one hand and a CEO claiming all-time highs on the other, they just don't add up. It's a puzzle, really. One side is telling you the story of incredible strength, and the other is telling a story of profound weakness.
Exactly. So, which one is it? Is this a trap for investors who think they're smart by buying the dip? Or is this a massive opportunity because the market is just completely overreacting? You know, the market is sending a really clear signal here that those headline numbers are masking a much, much deeper problem. We need to figure out if it's correctly identified a fundamental crack that's starting to form in Uber's foundation, or if it's just spooked by some short-term noise.
Okay, so to get to the bottom of all this, we're going to break it down with our standard plan of attack. First up, we are going to build the bull case. We're going to examine that steel frame that supports this entire company. Then you can grab your magnifying glass and show us all the little cracks that clearly spooked investors. After that, we'll look to the future with our autonomous blueprint, we'll analyze the sudden change right at the top, and finally, we'll weigh it all and deliver Iron Financial's final call. So let's get to work.
All right, let's dive right in. Look, before we can diagnose the sickness, we have to understand the underlying health of the patient. So let's build the bull case from the ground up and really look at the core strength of this global machine. This isn't about hype or narratives. It's about the foundational numbers. What is the steel frame holding this entire structure up? Let's find out.
The foundation? Well, it starts right here with the top line. $14.4 billion in revenue for a single quarter. Now, that is not just an impressive number floating in space. It represents 20% growth year over year. For a company of this absolutely immense scale posting that kind of growth, well, it shows you that the core engine is still incredibly powerful. This is the exact opposite of stagnation. This is powerful, undeniable momentum.
And what fuels that engine? People. 202 million monthly active platform consumers. Just let that number sink in for a second. That is the scale of a global utility, not just some tech company. And it's not just about maintaining that base, it's about expanding, and expanding aggressively. They added 31 million new monthly users over the past year alone. That's a staggering rate of acquisition that proves their network effect is not only intact, but is actually getting stronger every single quarter.
But revenue and users are one thing. In today's market, as we all know, cash is king. And this is the number that really shows that Uber has graduated from the cash-burning startup into a mature powerhouse company. $2.8 billion in free cash flow in a single quarter. For anyone watching, free cash flow is the lifeblood of a business. It's the actual cash left over after all the bills are paid, showing a company can fund its own growth. This is the financial oxygen that lets them invest, lets them buy back stock, and lets them weather any economic storm. This is a cash-generating fortress.
Okay, now what's really interesting when you look at this slide is the powerful symmetry of the growth. Just look at these key operational metrics. Trips taken are up 22%. Gross bookings, that's the total value of every transaction on the platform, also up 22%. Monthly users, up 18%. You see, this isn't growth in just one little silo. It's a synchronized humming machine where every single component is firing in perfect unison. This is that steel frame we're talking about. It's broad, it's consistent, and it is incredibly powerful.
Okay. The steel frame is impressive. I'll give you that. The numbers are strong, the foundation looks solid, but the stock market is a forecasting machine, right? Not a history book. It cares about tomorrow, not about what happened yesterday. And it clearly saw something that it believes is going to cause some serious problems down the road. So let's put on the skeptic's hat.
It's time to stop admiring the architecture and start looking for what actually caused that 9% drop.
And here it is. Crack number one, and believe me, it's a big one. The bottom line miss on earnings per share, or EPS. Now, for those who don't live and breathe this stuff, EPS is basically the ultimate report card for profitability. Wall Street analysts, they have built all their models and landed on a consensus estimate of 80 cents per share. Uber came in at 71 cents. That is an 11% miss. For a mega-cap tech company, that's not a rounding error, folks. That's a huge deviation that immediately makes investors question the company's profitability and, even more importantly, its predictability.
And this is where that little hairline crack widens into a real fissure. See, the market might forgive a backward-looking miss if the future looks bright. But Uber's guidance for the next quarter, well, it just poured gasoline on the fire. Analysts were expecting 75 cents. Uber's own forecast is for 65 to 72 cents. So the absolute best-case scenario from the company itself doesn't even meet what the market was expecting. This is the real red flag. It signals that the earnings miss wasn't just a one-time fluke, but potentially the start of a slowdown. The market is now asking a terrifying question. Is the hypergrowth story finally over?
Those are definitely fair points. The short-term picture, it has some blemishes that justify some caution. I'll grant you that. But truly understanding a company like Uber requires you to look beyond the next 90 days. The real heavy lifting for Uber's long-term valuation, it isn't happening in these quarterly reports. To see the full picture, we have to look at their blueprint for the next decade. So let's move on to the autonomous vehicle division and see how this builds the case for decades of growth, not just quarters.
For years, autonomous vehicles were just this massive cash burn for Uber, sort of a futuristic science project. But now, the strategy is really crystallizing. And the crucial point to understand is this: Uber isn't trying to build the best car. They are trying to build the most valuable network. Their goal is to be the essential operating system for any and all autonomous vehicles out there, leveraging their existing global demand to make any AV partner more profitable from day one. It's a classic and, frankly, a brilliant platform play.
And this slide right here perfectly illustrates their competitive moat. This chart shows that an autonomous vehicle that's operating on the Uber network completes roughly 30% more trips per day compared to a competitor who's trying to operate their own standalone fleet. So why is that? Well, because Uber has what the others don't: 200 million users and an absolute mountain of demand data. They can predict where the rides will be, reduce vehicle downtime, and just maximize utilization. Their network is a powerful magnet for any company developing AV technology.
Okay, but that's a great theory. Is any of this actually happening in the real world, or is it just a nice-looking chart in a pitch deck? I mean, how real is this AV deployment? Oh, it's very real. This isn't some little pilot program at a single parking lot anymore. They are already live in major global hubs like Dubai, Dallas, and Phoenix. But look at the upcoming list. That's where the ambition becomes crystal clear: Los Angeles, London, the Bay Area. These are some of the biggest and most complex transportation markets in the entire world. This is a deliberate, methodical, and incredibly ambitious global rollout. They are building the foundation for the future, one city block at a time.
In this right here, this is the mission statement that frames the entire long-term thesis for the company. We intend to be the largest facilitator of AV trips in the world by 2029. This is not some side project. This is a clear declaration of their intent to own the next tectonic shift in transportation. When you start to frame the company's future against a multi-trillion-dollar market like autonomous mobility, a one-quarter EPS miss starts to look a whole lot less significant, doesn't it?
Whoa, hold on a second. While you're over there painting this beautiful picture of the year 2029, the market is trading on today's news. And another major crack just appeared that adds to all this short-term uncertainty. One that you can't just brush off with some long-term vision. I'm talking about a surprise shakeup right at the top of the financial leadership. The chief financial officer is out.
And there is almost nothing that spooks Wall Street more than sudden instability in the C-suite, especially when it's the person keeping the books. I mean, when a CFO departs immediately following an earnings report that missed estimates and came with weak guidance, all the alarm bells just start blaring. It isn't just about uncertainty. It makes investors start asking these terrifying questions like, is there more bad news they haven't told us? Is the business harder to manage than it looks from the outside? Is there a disagreement at the highest levels about the future? That's the kind of fear that creates a sell-off.
Let's look at the actual facts of the transition. The outgoing CFO is Prashanth Mahendra-Rajah. The incoming CFO is Balaji Krishnamurthy. Now, the crucial detail on this slide is where the new CFO is coming from. He's not some outsider being brought in to clean house. He is being promoted from his current role as VP of Strategic Finance. He's been with Uber since 2019, and he previously served as the head of investor relations. So he knows the business, and importantly, he knows the investors.
And this is exactly how the company is trying to control that narrative of instability you're talking about. This quote, which we took directly from the official 8K filing with the SEC, is a strategic move by the CEO. He's not just announcing a change, he's delivering a very strong vote of confidence. By highlighting that the new CFO is trusted by investors and knows the business inside and out, they are framing this as a strategic promotion from a deep bench of talent, not a panicked reaction to a crisis. This is their attempt to reinforce stability in the face of all that market fear.
All right, we've laid out all the components. We've examined the powerful fundamentals of the bull case. We've identified those short-term cracks in the bear case that triggered this whole sell-off. We've explored the massive long-term ambition of their autonomous strategy, and we've dissected the shakeup in the C-suite. So now it's time to put it all together, weigh the evidence, and deliver Iron Financial's final call. Is this 9% drop an opportunity, or is it a trap?
Well, when you place it all side by side like this, the conflict becomes crystal clear, doesn't it? The bull case is really built on this foundation of tangible, massive scale. You've got platform growth that is accelerating, free cash flow hitting records, and their core operational metrics are just incredibly strong. Then you layer on this visionary, long-term AV strategy, and you have a really compelling story of a dominant global platform. But you just cannot ignore the bear case. The Q4 EPS miss was real. That weak Q1 guidance is an absolutely legitimate concern. And a C-suite shakeup right after a bad report is a classic red flag that points to execution risk. So the entire debate really boils down to one thing. Are these cracks we're seeing just cosmetic, or are they structural?
So here is Iron Financial's final call. The market sold off because it is a short-term thinking machine. It reacted to the miss, it reacted to the guidance, and it reacted to the CFO change. It saw a crack in the armor, and it ran for the exits. In our view, it's focusing on a few chip tiles while completely ignoring the solid bedrock foundation. The core business remains a global, cash-gushing machine with an undeniable network effect and a clear, ambitious plan to dominate the next era of mobility. The short-term headwinds are legitimate, but they do not appear to fundamentally damage the long-term structural integrity of the business. An 8.8% discount based on short-term sentiment may very well be the buying opportunity that long-term investors have been waiting for. So we'll leave you with this question to answer for your own portfolio. The market saw a crack in the armor, but is it ignoring the steel frame underneath? Thanks for joining us at Iron Financial.